Hello. Can you guys hear me?
Yes.
No? Okay. All right. Well, today, first things first, I think we'll finish up the classical sampling, which I think we're almost done with. And yeah. Do we do problem 3 together, or do we do that separate? I can't remember. All right, let me put it over. Do we do page 3 or do we do page 3 already? All right. I can't remember if we had this up last time. But anyway, so this is page 3. You should have that, and then it's a little bit fuzzy. A little bit better. And then this is what you should have for page 4. Any question on that? I think we did this one together. Okay.
I think we left off on page 3. Page 4 and 5 left.
Oh, okay. Okay, so this is page 3. And this is what you should have for that one, I think. And these are all overstated because this is 700, and these are all in 600, so it's overstated by a certain amount. Questions on those? Yeah, I realize I don't like this handout because I have the page numbering. I usually have the page number and the problem number are the same. When I do, I have large problems, and I realize that I put the numbering. This is problem number 3 on page 4. It's not so bad in this class, but a lot of times in the lower level classes, it's just easier to say go to page 2 or problem 2 or whatever. Everyone's on the same page. Literally everyone's on the same page. Okay. So that's that one. And then this is what you should have gotten for page 5.
Sorry, Professor, what chapter is this from?
Chapter 9.
It's not what you just give us. It's not an email what you just sent today, is it?
No. It's
okay.
From well, yeah, it's chapter 9 from last week.
Yeah, Professor, I have a question about which reading are we supposed to be doing each week? Are we supposed to be following the syllabus, or are you kind of going to have us jumping around?
No, well, the sampling is definitely going to be jumping around because I generally space that out throughout the quarter.
But chapter 5 that you sent today, I thought we were reading in 2 weeks.
I think I told you I'm going to do the chapter 5 first, the evidence, because the other ones are planning the audit. Okay. And it's kind of hard to plan the audit when you don't know the things that you do for the audit. For instance, you plan test of controls or substantive testing. That's all in there as far as planning is concerned. The problem is, unless you know what those are, it makes that chapter very difficult to kind of comprehend. So we're going to get a little bit of a background on some of the auditing steps and techniques. And then we're going to go back and say, okay, this is how you plan the audit. And I think it makes more sense to do it that way. Just from in the past, I've taught this class, or class similar to this, dozens of times. The planning chapters are generally pretty difficult for some. Now, well, let me ask you this: is there anyone here that has not had an auditing class that had sampling and testing and all that kind of stuff. Is there anyone here that did not have it? If you guys have already had test controls and all that kind of stuff, then I don't have any problem doing it.
This is new to me. I just wanted to make sure I'm doing the reading in the right order. So I like to come to class having done some reading before
Chapter 5 is what we're starting at. I think I talked about that. Yeah.
And then do you need us to read 8 and 9, or was 9 just like this classical sampling was just a small piece of 9?
Generally the sampling stuff, you certainly can read it. There's nothing wrong with reading it. I do my handouts for sampling are pretty much lined up with what's on the CPA exam. The CPA exam up until 1996 was an open exam. What I mean by that is you would actually go and take the exam. They give you two things. They give you the booklet with the exam problem, and then they give you an answer sheet. And you turn in the answer sheet, and then you'd hand them an envelope, and they would put in the actual exam that you took and mail it to you. So the CPA exam, you'd actually see the CPA exam questions for every CPA exam up until 1996. Now, this is sampling. Sampling hasn't changed since 1996. It's still the same. There's no new breakthroughs in sampling. So a lot of these questions are, you actually can get real CPA questions about sampling that were actually on CPA exams. And that's kind of what I gear my my lectures to. Nothing wrong with looking at the book. But again, I usually use my stuff because I know this is the way that you're going to see it on the CPA exam. But yeah, I mean, yeah, and now actually, I am going to pull up later on. I'll pull up a few minutes here. I'll pull up something out of the book just to kind of show you a little something about classical sampling. But but mostly what is on this handout is about as much as you're going to see on classical sampling on the CPA exam. So if there's something I need you, if there's something I want you to read, I'll tell you to go ahead and read it. If not, I mean, you're certainly welcome to look through the chapters, and like we got chapter 5 coming up. We're going to do a little bit of that today. Going through that, there's nothing wrong with going through that. Just know that the textbook is not the class, though. It's in addition to the class. It's not the class itself. Okay, so yeah. So anyway, that's that's kind of the gist of it. And anything that is due, let me see here. Oops, wrong. Let me check. Anything that is due, share the screen here, will be in submit coursework here. So for instance, we finished the chapter 1 and 2 handout last week. There's a drop for that. I don't have that as you grade today because it's just one handout. It's, whatever that is, if you've already turned it in, I'll go ahead and put a grade in for it. But there's no test or anything on that. So chapter 5 is going to be the first test that we have, the first chapter, first test. And we're going to go next week. We'll have some CPA exam questions, some multiple choice questions, which is really where you learn the stuff. It really drives it home doing the CPA questions. They're tough and they're very direct as far as what they test. So we'll do some of those, and then I'll give you guys the exam. And the exam is basically multiple choice questions, similar to what we'd have in the review, and then also so essay questions for the most part. And you'll notice that these exam. Pull the book up here. I'll stop sharing. I tell you, let me go ahead and finish this the classical sampling, and then we'll kind of go over basically what I'm going to have for the class. And I have no problem. I'll tell you what, I'll make a tab that'll kind of show where we're going to go. That'd probably be helpful for you guys. So I'll make a tab in the thing that says kind of where we're going to be at certain times for certain weeks and all this kind of stuff. Yeah, that'd be. I understand that the syllabus now is more. It's more leaned upon than in the past because we're doing everything online. All right. Oops, wrong thing. Okay. Yeah, so this is the accessory pages 4 and 5. Now, the last page is an important one because it it kind of is about, well, when do you get three different answers for this. Well, which one do you use? You have 3 different answers, and the question is, well, which one do you use? And this kind of explains a little bit why, or which one do you use. Mean per unit is used when the items in a sample have similar values. So when the items in the sample have similar values, the mean per unit is a good one. So if you're doing in commodities, for instance, different commodities will have different standards for cost and pricing and all that kind of stuff. So things that are similar in values, the mean per unit is a good one. And this one is, they talk about in the book, Jason and I were talking about this earlier, that if you don't know the book value, which, what are you auditing? But anyway, if you don't know the book value, you can use this one. But this is one that you can use for about anything. I mean, this is one of those ones that, for instance, if you're, like I say, there's ducks on a pond and there's 100 ducks, and you can get 5 ducks and weigh them, and you can probably get what the total weight of the ducks on the pond is using this method. So, this is it's used for us for estimation, but it can also be used for almost anything. And if you think about ducks, they're all kind of the same weight, I guess. So you could actually use it for figuring out the total. Ratio estimation is used when the errors in the sample when the errors in the sample are proportionate to the item's value. In other words, large items, large errors, small items, small errors. For example, if you have 2 orders, one is for $10 and another order is for $6,000, the idea is that the $6,000 order could probably have a bigger misstatement than this one, which kind of makes sense. And you're talking about, especially you're talking about, finding errors in populations. If you think about this one, probably the most it could be off by is $10, something close to that. Whereas this one, it could be off by $1,000 or something. So, that the misstatement here would be that errors would be larger for this one. So this one would have larger errors or larger misstatements. Oops. Of the three, this one is probably the more reliable overall doing your testing. You know, if the items aren't all the same, this one's not a very good one. So if you could have a variability between the items, and if the larger ones have larger misstatements and the smaller ones have smaller misstatements, this is a good one to use. And this kind of makes sense, right? I mean, the larger the order, the more likely it could be misstated. Difference estimation is when errors in the sample are the same, regardless of the item value. So looking at this, it would be, okay, the error is likely to be the same whether it's a $10 order or a $6,000 order. For example, suppose that you had a $5 handling fee for all orders. And sometimes that handling fee doesn't get put on the order, or maybe it gets put on orders that it shouldn't. But you know, whenever there's an order, there's a $5 handling fee, and so if it's missing, you know, it could be missing on a $10 order, or it could be missing on a $6,000 order, but the error is always the same. It's 5. When you have this one, difference estimation is a good one to use. Now, notice that it's not proportional. You know, we have 2 orders here, and this is basically kind of per order. So, you know, this order could be up by $5. This order could be up by $5 because this is where we find a lot of the errors are in the handling fee. So if that's the case, then different estimation is a good one. Question on that? Okay, there is, generally speaking, classical sampling is probably the most intuitive one of all of them. That these are the ones that are most people think about when they think about sampling, that of finding out an estimate. But there is at least one kind of drawback here. Let me see if I make sure I have it up here. Okay, so this is out of chapter 9. And here is the problem. I could make this. I wish I could make this something different than light blue on white. But anyway, hopefully you guys can see that. Oops. I lost it. No, I didn't. It's back this way. Okay. This is how you get the sample size for it. And most of this is not that, you know, the figuring it out isn't a problem. This SD here is a problem. So if you want to get the sample size of the population, this is the formula that you'd use, but the standard deviation is the problem. The standard deviation in the for the audit differences. And here is why that is a problem. That is a problem because what you end up having to do is, let's get your camera back in front of you. What you end up having to do is to get a pre-sample. If this is your first time auditing this, you know, this group, this company, you have to get a pre-sample and find the standard deviation of that pre-sample, and then plug that in and get your population size. So you actually have to do testing before you do testing. You have to actually get some items out of the sample to get a standard deviation, which is, I mean, it's not impossible, I think, but it's another hoop to jump through. And one of the things that I'm going to show you the dollar unit sampling, which is a different method where you don't have to do that. So you have to take a pre-sample if you don't know the standard deviation. Now, if you did the audit last year, you might use the last year's as your standard deviation. What was the standard deviation last year? You know, unless and if nothing has really changed, you can probably get away with using it this year too, keep the sample size. But it is something that you have to do ahead of time that makes it a little bit more cumbersome than, say, some of the other methods. Now, on the CPA exam, they will not generally ask you about the about this equation. They won't have you calculate the sample size, but they will ask you questions like this. You know, an increase in the standard deviation will have one impact on the sample size. So you kind of know this formula a little bit just to know how it impacts. So, you know, if the standard deviation is higher, this would be bigger. Bigger stuff on top means a bigger sample. Tolerable misstatement. What would happen if your tolerable misstatement increased? And this is what you'd accept as a misstatement. If that increases, this bottom gets bigger, your sample size gets smaller. So if you allow for a larger, misstatement, you can get a smaller sample. So while they don't, I don't think they've ever, I could be wrong, I don't think they've ever actually had you calculate the sample size for a, for these classical sampling. But they will ask questions about how it will change the sample size. You know, different things will change the sample size. The estimated misstatement, how will that change the sample size? That sort of thing. So they won't actually, come right out and say, calculate the sample size, but they will ask what will happen to the sample size if this occurs, if the standard deviation increases or decreases, what will occur to the sample size. So you do have to know a little bit about that formula when you go in. And again, when you sit for the exam, you don't have to memorize it now. When you sit for the exam, you're going to know that, you're going to at least know which way the sample size will go depending on how they change some of the variables. Any questions on that? Okay. Well, one of the things that I'd like to do now is, I should have included this with the chapter 5 from last time, chapter 5 handout from last time. But the chapter 5 handout I sent out today, the one about the revenue assertion testing thing, I think I want to go over that just because I think it'll be good to get a feel for what we actually do in auditing. How do we actually test things? How do we actually see if what they have is fairly presented or not? And I think that'll be a good one to go ahead and to do. So it's the like this. I think I'll just go ahead and do it on let's do it on the file itself. So if you let's pull that up. So it looks like this one. And it has all the assertions. I think we talked about a little bit about the assertions. And yeah, I'm sure you guys had that in other classes. Don't fall over. Don't fall over, Mike. Okay. So yeah, these are the assertions. These are the assertions for the PCAOB. Value allocation, and I think they included accuracy on this one too. I'll put another hand. So these are relations for the PCAOB. Down here, these are the AICPA ones. Probably have room. in here. And these are kind of, until you do something with them, they're kind of, I don't know. They don't seem as real or something until you actually kind of figure some of them out. So that's what we're going to do today. This shouldn't take too long. We're just going to go ahead and go through and find out what assertions you're testing for, and we're going to do it based on the sales cycle. Oops. Okay, so on page, is that two? On page 2, this is kind of how the whole sales cycle kind of comes about. A customer will send over a purchase order. Now, today in electronic age, it could be done electronically, but somehow the customer is going to get the purchase order over to the sales department. From that customer order, the sales department will put in a sales order, and it'll go to the shipping department, which I kind of combine, say, sometimes they'll have the people that pick the order different than the shipping people, but I just kind of combined them here. So go to the shipping people, they'll get the order together and package it up and do all the logistics of how they're going to get it to where it is, the shipping. And this is kind of the important documents that we're going to see for this. First one is a bill of lading. That's probably the most important one. A bill of lading is a document that it doesn't have any values on it. It's simply a listing of the items that are being shipped. And if you think about shipping, it's kind of a little bit of a weird thing, because what you're doing is you're actually taking merchandise that you don't have title to and putting it on the truck. That's from the trucking point of view. So this bill of lading is kind of like a acknowledgement of what is put on the truck, and it's a document that travels with the goods to wherever the destination is. And again, it doesn't have the prices on it or anything like that, but it is a description of the goods. And so there's a document that is given to whoever is shipping the item. So the bill of lading will actually travel along with the goods. And that's an important document, because that means that there's someone, a third party shipper, has acknowledged taking those items. So it's an important document in that way. Proof of delivery, while that one might seem like it's more important than a bill of lading, it's generally not. And here's why. The bill of lading at least shows that whoever's selling it shipped something. It's proof of shipping of something being shipped, right? Whereas proof of delivery, something could have happened in the shipping. Truck gets stolen, truck bursts into flames or whatever. That it is possible that they had actually sent it out, whatever these goods are, even if it didn't necessarily get to where it was supposed to, or didn't get there on time or whatever. So bill of lading actually is probably the most important of those two, simply because it is evidence that something was loaded on the truck, whatever it was, and there's an agreement with the truck driver, or the shipping people will sign off on it, that this is what they had put on the truck. So it's a third party verification, basically, of this is what was on the truck. Okay, now going to the billing department. And this is a little bit tricky in that the shipping department, there should be, before you go to billing, the item should be shipped. Right? If you still have the item in your business, it's not a sale. So billing should generally be done after the item is shipped. It doesn't always work that way, but that's ideally that's what it should be. So when the item is shipped, then you goes to the billing department. They send the client their invoice. So I'm sorry, the client, your audit client, whoever this is. So for instance, if it's IBM will send an invoice to the customer saying, look, we sent your stuff. Here's the invoice for it. You know, this is what you owe on it. From the billing department. So now there's been a sale. They're going to update the sales journal, accounts receivable journal, and the inventory cost of goods sold stuff will be taken care of. They'll take those things out of inventory. And the sales journal will then feed into the general ledger. So this is kind of how the, you know, customer purchase order, ship it out, bill of lading, billing department, client sales invoice. That, you know, this is IBM, so maybe I should have this. I don't know if I can put it in there. You know, for instance, if the client was IBM, this would be IBM sales invoice. You know, whoever's the seller's invoice, it would probably be a better way to put it, sales invoice. Okay, so it goes into the sales journal, accounts receivable journal, and inventory ledgers, and then those will feed into the general ledger. And actually, verifying these is actually usually fairly easy. The sales journal should, whatever the total is in that, should go right into the general ledger. Same thing, accounts receivable journal and inventory journal. These are all special journals. And those will feed right into the general ledger. So you'll go from this sale, eventually ending up being in the general ledger. Any questions on this thing? Okay, well, let's do some of the, move down a little bit. Let's back up. Let's do some of the testing. And this is testing, what they call testing of the revenue cycle, kind of how you would actually test things through the different parts of the revenue cycle. So on page, maybe I should have this. Hold on 1 second. So this being on my big mug. Let's put up this thing on the side. And if you do a tile screen, you can actually do both those at the same time. Okay, so how would you confirm that all customer orders have been shipped? Where would you do your testing from? Where would be your starting point? Don't be afraid to make a mistake.
What was the question again?
It's number one. How would you confirm that all the customer orders have been shipped?
The shipping documents.
Okay, from what to what? So from what?
Are we going based on the little diagram on page 2?
Yeah.
Okay, so will it be from the shipping department to the bill of lading?
Probably not. So we're looking at the customer orders, right? So we're probably going to say, okay, look at the customer orders. And we want to make sure that all these are shipped. So the customer purchase orders, so that these are actually shipped. So we take some of these customer orders, and then how would we determine if they've been shipped? What will we test to?
Are we going to look at invoicing and shipping documents, showing like they invoiced them out to the customer? That would be the recognition of the revenue. But the shipping documents themselves would show us that the customer's something left, right?
Yeah. So this would be what we test to see if they've actually been shipped. So the customer purchase order to the shipping document. This would tell us that something has been shipped out. And what assertion would that be? This one's a little bit more difficult than some of the other ones. But what do you think? Well, the most would this probably be an indication of?
Is this assistance?
It that's not a bad one. I would say existence. It could also be the occurrence that there's actually been a sale made, but existence of, and because there's going to be accounts receivable in that too. But certainly this is indication that there has been something that has been ordered, and because there's a shipping document, that it means that it actually has left a place. Something has left the place. So this is definitely a sale that did exist. That probably is the best one. Yeah. So going from one to, how do you test these things going from one? And one of the things that they'll do in the CPA exam is they'll ask, how would you test this? From what to what? How would you test that all shipped orders have been billed? And this is key. So anything that's been shipped, you want to make sure that everything that's been shipped has been billed. So where are you going to test from?
I would definitely say sales invoice to shipping documents.
Close. Is you're going to test from the shipping documents because you want to see that everything that has been shipped. Oops, there's something wrong here. So everything that's been shipped has been billed. So where are you going to go to next? I think you had it.
Sales invoice.
Yep. Yeah. So we're going to say, okay, here's the shipping guide. So this was shipped. Now we're going to trace these shipments to the sales invoice to make sure that these have been billed. And what is that going to test for?
Occurrence or completeness?
Probably completeness. Yep. Yeah, you want to, because you're going to say, okay, look, are these, here's a shipment. So if we're starting with the shipments and shipment documents, so if there's anything missing, it'll show that it's not complete, right? If there's no sales or invoice for one of the shipments, it'll say, okay, well, this isn't complete. So it's going from the shipping documents to the sales invoice. Again, so whenever you're testing, you know what you're going from to. So this would be to say, okay, grab some shipping documents and then see if there's sales invoices that go with it. And if there's not, there could be a problem. Complete. Okay. This one's a little trickier. How would you confirm that the customer orders were billed for the correct amount? This one, the to and from could probably be interchangeable. You're going to compare two things on here. Where are they? Well, let's go here to the from. Which over here would have the amounts would have the dollar amounts on it for each item.
I would say purchase order starting off.
Yep. So purchase orders are done. So when they send it over, they're usually on the purchase order itself, there will be the dollar amounts, whatever it is, you know, they're in 50, whatever, and $2.38 each order. So what would you confirm that they've actually been billed for the correct amount?
Sales invoice.
Yep. Good. These are tough. So you're going to compare what the customer has in the purchase order compared to the sales invoice. And if there's a difference, there should be some reason why, or it should be accepted by the customer or whatever. So customer says it's $2.38 and they're billing $4.22. That's one of those things that, it goes into a contract law, basically, that they think it's for one price, and there's actually another price here. This is actually would be a second offer, unless it's accepted, it's not considered a contract. But anyway, these two should match. And usually there should be a purchase order, and the purchase order should be accepted at whatever they agreed to as the price for the sales invoice.
So this could be like a keying error. Somebody in customer service adds a 0 or something like that. Wouldn't it be
Absolutely
accuracy? There's no accuracy as the assertion here.
It could be for accuracy. Accuracy is for each of the transactions, and it could be there. The one that I was thinking that it might be from what we have is the valuation, that their valuation of the invoices. And again, if it's a keying error, it probably should be random. However, what you're looking for is there are companies that will systematically try to inflate sales by adding 2 or 3% or whatever onto the sales invoices and so forth.
I've also seen where customers send an old price over from 2 years earlier, and then there's cases, and they want their they want the original price before inflation. So, but it's funny because usually in an order status, in some order confirmation, you would kind of correct that.
Yeah, there are all kinds of games. I've been in companies where there's constantly some shipper that underships it or overship. There's all kinds of.
But
games.
For the auditor, you would not want to see these variances without an explanation if it was on a regular basis and you started seeing.
Yeah, you're looking for a systematic problem. You're looking for something that might make the financial statements not reliable. Okay, so you're looking for something that is systematic enough that it's going to have a large enough impact to this material. One or two of these being out of line is not going to do anything. But if it's systematic, that okay, these are all being overcharged, or whatever, that they might be inflating it. And you also might look and see another way you could actually test it too, though, is see what the remittance were for those same invoices, because there might be people, there may be customers that are actually just paying what the agreed upon price was, no matter what the invoice is. So say, okay, why is this customer paying 10% less? Well, because they're overcharged by 10%. So it really depends on, there's other things you can look at, certainly, to see if there's a systematic problem to it. Let's see here, we got to change the okay. Okay, so yeah, accuracy would also be one that you want to look at for that. And the accuracy is we never say that financial statements are accurate, but what we will say is that every transaction should be accurately. We expect that every transaction be accurately completed. Okay. How would the auditor confirm that all billed orders appear in the general ledger? So they have billed orders. And they want to know if these billed orders are actually making it to the general ledger. What would be the from? Which thing over here shows that they were billed?
It was billed by the invoice.
So this shows that they're billed. And then how do we know that they appear in the general ledger? And this might be a kind of a two-step thing here, actually. So there's actually two of them that would probably be acceptable over here.
Sales, the sales journal and the accounts receivable journal.
Yep. So those two should be there. Now, these two should flow into the general ledger. So eventually they're going to end up in the general ledger. And quite honestly, again, these should be very simple to go into the general ledger. You know, whatever the sales journal is, whatever the accounts receivable journal is, they should go in there. And this would be to test what? You know, so we're taking the sales invoices and then tracing them into the, let's use the sales journal, tracing them into the sales journal. So what would this be? What would be the assertion they're testing for? To see if the sales journal.
You were trying to fake revenue, you would wouldn't you want to make sure this was is it completeness, that like all invoices end up, or in other words, all revenue that's showing up in the accounts receivable or the general ledger has invoices to a customer?
Yeah, you're testing to see the invoices. So these are what were sent out to the customer. You're checking to make sure those all end up in the sales journal. And it is a completeness test. You're absolutely right. This is
works both directions, right? If somebody put a journal entry in to add $1 million at the end of a quarter, you would want to see the invoices.
Then you go, yeah, you would go from the sales journal to the sales invoices. Yeah, you're right. You can go both directions. Going from the sales journal to the sales invoice would be in existence. You know, so if there's something in the sales journal for $10,000, there should be an invoice for that. And if there's not, it's probably fictitious. This would be more along the lines of they're trying to, if this was done purposely, it could be a mistake. It could also be if there's a sales invoice that doesn't show up in the sales journal, it's also possible that they are trying to understate their sales. Why would they do that? Why would a company intentionally understate their sales?
Maybe they want to push it to the next quarter.
Be pushing to the next quarter. They could also be trying to avoid taxes.
Yeah.
How do you avoid taxes? You don't record the sale.
So you could underreport revenue, or you could be sort of your cookie jar accounting.
Yeah. Another thing, people, they try to, if they have a really good quarter, you know, they tuck a little away for next quarter in case it's bad. But so very well it could be though that there's a sales invoice that they don't record purposefully, and you'll actually, for instance, businesses that do their work in cash, sometimes you'll see them do this. They'll hold off on making deposits until, you know, January 1st. January 1st, they have a tremendous day. Okay, so So this is, kind of how you, and by the way, the CPA exam, a lot of times, this is, I can't, I don't even know how many on the review we went through on those, probably 50 of these. It's such an easy thing to, and another thing about the CPA exam is that there's tons of real CPA questions on this, because this hasn't really changed either since 1996, 25 years ago. Okay, how would you confirm that all shipped orders were billed? So something is shipped out, but not billed.
How is this different than question? This is our second question. Let's see.
Be the same, I don't know.
In this one, it said all shipped orders had been billed. And this one says all shipped orders were billed.
You're right, that's the same question. What do we answer for that one? See if it's the same. Yeah, shipping
Just making
documents.
sure I'm not misunderstanding had been versus were.
Yeah, I'm sorry, that's me making a mistake. I put the same one there. Oh, this is wrong. You think I get it right the second time. So yeah, the shipping documents. Let me see if there may be a subtle, no, it's not. And one of the things you would also do here, I think I know what I was trying to do on this one. On this one, I think what I was getting at was you actually look at the shipping documents at the end of the year, and this I think I've seen this being a cutoff test. We have to look at the shipping documents at the end of the year and making sure that the last shipping documents that there were sales invoices for, to making sure that other ones at the end of the year were shipped out. And we used to, that used to be coming down here. That used to be part of the valuation, or complete. Nowadays they have an actual thing for a cutoff. So it could also be a cutoff if these were at the end of the year. I should say, or build a year on this. And then we do just the opposite down here. And this one down here is actually more of a problem. How would you confirm that all billed orders were shipped? Year round. Hey, I like it. And so that's kind of going the other direction. It'd just be the opposite of here, and that is that you have your sales invoices, and you trace those to shipping documents. Now, there should be shipping documents for these sales invoices, and this is one of those things that you can actually run into problems with, and it's not that uncommon. Is that if something can't get shipped out, they'll record the sale anyways, and until it's shipped, it is not a sale. So if there are no shipping documents, it's not a sale. And this one actually is more of a problem. It could be genuine sales that they have made, or genuine transactions that someone has called for sale, whatever, and they just can't get it out. And they tuck it in the corner and they say sold, mark sold on it, doesn't count. And so if it's not shipped, it's not sold. There are a few exceptions to that, but they're pretty rare. So anyway, this is a, and this one's more serious usually than this one. Usually something that there should be, if there's a sales invoice, there should be a shipping document that goes with it at year end. And a lot of times what you look at is the last shipping document recorded. You know, what was the last shipping document recorded at year end? And anything after that, there shouldn't be any sales for. This would be which? So let's say that you found an invoice, but there were no shipping documents. What would that indicate?
Existence.
Yep. Okay, what are legitimate reasons that the customer purchase order may differ from the sales invoice? So what are legitimate reasons that they could be different?
Back order products.
Yep. Yeah, it's very common. And one of the things that's a little bit irritating sometimes in some of these, they talk about matching these up and all this stuff, is that oftentimes, I don't know why I'm using this. I could use the other one. It'd be a lot easier. Yeah. There's a lot of times, you know, they send a purchase order over and there's things on back order, the things they don't sell anymore. Could be that they have things that are substituted. There's all kinds of reasons why this purchase, you know, because sometimes you'll see in some of the writings about how the customer's purchase order should match up perfectly with the sales invoice. That's not true. A lot of times there'll be things that are back ordered and so forth that won't show up on the sales invoice because they don't have them, or they weren't shipped, or there was a substitution made, or whatever it is, you know, that the customer agreed to. So there are legitimate reasons why this doesn't always match up with this down here. There's illegitimate reasons, but there's legitimate reasons why those would be the same. But anyway, so this is a lot of what you do in auditing. A lot of times you'll be tracing from one to the other and seeing if there's a problem going from one to the other. And the two that you run into the most are these two, the existence and the completeness. These two are the ones that really, if you think about it, when it comes to the numbers on the financial statements, these two are really, you know, the ones that get hit the hardest. You know, does it exist? Do you put something fake on there, or is it complete? Are they leaving things off? You know, those are the two that are probably tested the most. Yeah. Question on that? Okay. Well, stop saying. Oh, that doesn't look very good. I think what we'll do is let's go to chapter 5, the handout I sent last week. Hey, all right. You guys want to take a break?
Sure.
Okay. We'll take a break. We'll be back in a moment. I don't know. How about see, it's 6:59. How about be back at 7:05? Okay. Okay, I think we'll go ahead and get started on the handout. So this is a chapter 5 handout. Starts out with these. We're not going to do these. You can write these in if you want. They're already included in the other handout. But these are the assertions, and it's good to get a feel for them to go through. I would, if you're taking the exam, I definitely encourage you to write those out at least once, just to make sure. But usually they ask whether what you're testing to. So these are the ones that you probably want to know at least what they are. But for the most part, the questions will not be, what does classification mean or whatever. It's going to say, here's a test. What are they testing for? That sort of thing. Okay. Coming here, definition of evidence. And this is one that evidence. Oops. Gotcha.
Professor, did you send this to us? Because I'm not seeing.
I sent it last week.
Oh, okay.
Yeah, it's in the last week. I think it's in black. Let me make sure it's in Blackboard. Yeah, it's actually in Blackboard too. It's near the bottom. Is there anyone else that needs it? I can send it out. Oops, what am I doing?
It should be in the same packet we had with the classical sampling. It should be on page, well, when I printed it out, I printed it all out together. So it should have been in that same email from last week.
I can resend it. I think 2 seconds. I'm going to do that.
I found it.
Oh, you found it? Okay. Okay, I'll stop doing this then. All right, so anything that corroborates or refutes a relevant assertion. So it's anything that it either corroborates it, says, okay, this is right, or it refutes it. So this is okay, this is wrong. So of these assertions up here, on page 1, evidence is anything that corroborates it. So if you test something and it comes out okay, that's evidence that what they're doing is not materially misstated. And or refutes. If you're testing for you see an invoice and you pick up an invoice in your sample and you can't find a bill of lading for it, there's no evidence of it, that refutes their assertion that this sale exists. So it's anything that corroborates or refutes a relevant assertion. And if it doesn't, it probably isn't relevant to an audit. Okay, sufficient and appropriate evidence from opinion. Okay, well, sufficient just means what? Say equals enough. Inappropriate is sort of a quality that it's appropriate. Oops, So it's sort of like you have enough good evidence, and you have to get enough to form an opinion. You know, this is really the whole audit is to form an opinion. So you have to get enough quality evidence to, you know, form an opinion. And relevance, is that it? Relates to the audit. So it relates to the audit in a timely manner. And what we mean by that is that it's got to relate to the audit, obviously, to be relevant, whatever evidence you have should relate to the audit, but also in a timely manner. You know, and the timeliness is something that is, it makes for uncertainty, but it also, it relates to uncertainty, but it also is there for reasons of being useful. So for instance, if they say the equipment's gonna last for 5 years. So yeah, well, let's wait 5 years and see if this equipment really lasts for 5 years. Maybe it only lasts for 3, or maybe it lasts for 7, or whatever. Well, getting information that's 5 years old, while it is more accurate, certainly, it's not relevant. You know, something that happened 5 years ago isn't gonna be wrong. So there is this idea that we have for, there's also a time factor in this for things to be relevant. Okay. Independent source outside the entity. This is so this is all relates to reliability. In other words, can we rely on the evidence? And there's a hierarchy of this. And they also talk about this in the CPA exam hits this, not terribly hard, but enough. Okay. Created by and held by a third party. So in other words, not the client, but somebody on the outside. For example, stock quotes. You look at the Wall Street Journal for stock quotes. So they may have stock they hold, and they may say it's a certain value, but if you look at the stock quotes right from the, say the Wall Street Journal, it's a third party. They have no relation to your client. And so those are held as more, as better evidence. So the best evidence is going to be here. The next best evidence is created by a third party. And held by the client. Example, bank statement. So the bank makes the statement, sends it to the client. So the client holds it, that's the bank statement. I should underline these. I say examples. All right, so, and we'll call this medium evidence. The worst evidence. Is evidence that's created by the client and held by the client. Let's see. I'll say that they're, for instance, their general ledger. But it could also be the documents they make. For instance, a sales order. Sales order is internally generated, held, is made by the client. It's held by the client. It's not great evidence. All right, and now here's the thing about this evidence too, though. We do sometimes, if we have evidence, we want to move it up. So it is possible that we have the bank send the bank statement directly to the auditors. So if we can get this bank statement sent directly to the auditors, which is a very common practice, that will move it from a third party. And then if the client never gets a hold of it, it goes right to the auditor's office, that can move it up. So we always try to move stuff up this, this sort of quality of evidence chart. Try to move things up into the next level to make it into better evidence. So a very simple thing to do is have the bank statement sent directly to the auditors. Now it's the best evidence. You cannot use the client's accounting information as the basis of your opinion. So this is not something you can rely on for the basis of your opinion. There has to be some kind of verification of those things. Now, you might try to move stuff up from the client, moving up, and there's a few different ways to do that. But generally speaking, this cannot be what you rely on for your audit. You can't simply rely on their records, basically. Okay, so reliability. Effectiveness of internal controls. This is kind of an obvious one. So if they have effective internal controls, that will generally make the evidence more reliable. So good internal controls will increase the reliability. So if they have good internal controls over sales, for instance, generally that makes the evidence that you'll gather for sales more reliable. And vice versa. If they don't have bad internal controls, yours will have some skepticism about the. Okay. The auditors. So the auditor's direct personal knowledge is more convincing than secondhand hearsay. So, just because the controller says this, if you have personal knowledge that contradicts that, your personal knowledge is more convincing than secondhand accounts. That should be obvious, but that is part of it. Documentary evidence. Much of the auditing is going to be done on documentary evidence. Documents are the validity of the document is one of those things that you've got to be careful of. But you always look for documentary evidence to actually kind of like up here, corroborate or refute a relevant assertion. Oops. By the way, relevant assertions, the book I think uses the term management assertions. It's a little bit of an old term. It's not bad. It just because they do come from management. Original documents. It's fun watching me learn how to type. Copies are not acceptable as evidence. Now, you may if you get the actual, if you see the actual document itself and make a copy of it for yourself, that's fine. But the client, you should never accept copies from the client. So you always get the original documents, and if you want to make a copy of them, and you probably will, it's fine. So I'm not saying that the copies that you make of the originals are bad. It's just that you have to see the original document to know that it's you know. Tell me up and up. So copies are not, you know, saying in auditing, copies are for crooks. Okay. Something I don't know if we need to go into too much here. Inspection of records and documents is obviously something that you can in every audit. So, and the client should have, and this also depends on the client's internal controls. So, this is basically just the auditors. And again, the quality of those depends on who made the documents, who's holding them, and all that kind of stuff. Inspection of tangible assets. So one of the things that you'll actually do is go around and view tangible assets. And if there are things like equipment in that, there should be an asset tag on it. That's a tag that's put on an asset. Yeah, so when I was an auditor for US Steel and for Navistar. And for both of those, we had to, especially for Navistar. Navistar makes trucks. And so we actually have equipment and we go and look at the equipment, actually see the tangible equipment. So if they said they had a whatever, drill press or machinery or whatever, you go look at it and there was a tag on it, and that tag which should be traceable back to the inventory. And you do it in both directions. So you should be able to find something on the floor, go back and tie that into the general ledger. You should also be able to take something from the general ledger and go back onto the floor to make sure it's there. And one of the tricks is when you look at equipment, taking old equipment that's on the books and then tracing it back to the floor, because something being disposed of is much more likely to be missed than something that's purchased new. New equipment, there's all kinds of stuff. There's receiving reports, there's invoices, there's payments made, there's all this stuff. But when something is disposed of, it could just be someone on the plant floor puts a thing on a cart, walks it out to the back, and the recyclable guy comes and takes it. And so you always, one of the things you check on is things that are disposed of are much more difficult to or can be more problematic, I should say, than new things in general. So look at old equipment, look at the tags, and then go back and try to find them, because a lot of times you won't be able to, or sometimes I should say, because they may have been already scrapped. Okay. So inspection of tangible assets. Observation is very important. Observation, and this is actually a big one. Observation is you actually watch somebody do something. I can't tell you how many times I've had people that have, you ask them, what do you do for this? And they say, oh, well, we do X, Y, and Z. And, oh, okay. And you go and watch what they're doing, it's completely different. And sometimes you even say to them, well, look, I thought you said it was like, oh, well, yeah, well, we don't really do that anymore, or whatever it is. So, it's always good to watch what people do. And again, this goes back to your own direct knowledge. That if you see people doing something one way and they're telling you that someone's saying it's done a different way, your personal knowledge is more important, holds more weight, more convincing than what they tell you. So a lot of times observation is a very good way of doing it. I can't tell you how many times I've run into this where people have told you that they do things one way and it's actually done different. Sometimes they tell you what they think you want to hear. Sometimes that's the way they think it's being done. They don't know that it's being done a different way. Inquiry, simply talking to people. Find out a lot of stuff by just talking to people sometimes. when I was doing internal auditing, quite a bit, it was just talking to people. We get you a lot of times get you the information you need, and talking to the people that are actually doing it. A lot of times, people who are higher up, they really don't know. You know, you talk to somebody who's the head of operations, you ask them about how do they how do they process return items to stock, and they'll have no idea. But if you just talk to somebody who's actually doing it, a lot of times they'll tell you exactly how things happen, and at least get you started on what to look for, and then observe and see what they're doing. Confirmation. And this is a good one. So confirmation is when the client's information is confirmed by a third party. So a confirmation is, it could be for accounts receivable, which is very common, it could be for accounts payable, which are less common, but confirmations are when you confirm the client's information with a third party. And again, that moves it up that scale. So for instance, if you have accounts receivable, that's clients, a client's invoice and the client's created it. If you can confirm that with a third party, that moves it up. All of a sudden, that's going to be a third, up here to the best is if you have a third party confirms it, because the third party should have the same information and they're holding on to that information and they're going to confirm that what is done. So you're always trying to move stuff up, and a confirmation does that, moves it up, because now it's a third party that is acknowledging it. Recalculation. So simply recalculating some of you can, and this one is a this one's kind of a little bit of a funny one. So this is actually just taking the client's documents and making sure that they are, so for instance, whatever their net income is, we calculate the net income, we calculate the assets and all that kind of stuff. This is only, a lot of this is footing stuff. I'll tell you kind of an odd one I had, and that was I had an inventory listing at the end of the year. It should match up with the general ledger, right? So, we had an assembly plant that had their inventory, and that should, at the end of the year, whatever's on that inventory should be the same thing that's on the inventory for the general ledger. And it's again, this is usually a 3-minute thing to verify. You get the inventory at year end, get the total number, you see it in there. There might be an adjustment here or there or something based on whatever. But for the most part, it's going to be a fairly simple, fairly quick test. It's not really those things. So I did it one time and it didn't come out. What was on the inventory? It wasn't off by a lot, but it was off by some. I don't know, $5,000 or whatever it was. And it kind of bugged me that, why doesn't this match up? And I went to talk to people and they all seemed kind of tight-lipped about it. So, and at that point, when people don't want to talk about it, that's when you got to figure out what it is. So anyway, come to find out that they had hired this new purchasing guy. And this purchasing guy was actually renegotiating contracts for purchases that were already made. So he'd renegotiate these contracts saying, okay, well, last year you charged us $4.30, but we, you know, if you can change that to $4.15, you know, then we can do, you know, so he had all this stuff that, you know, going back to contracts that were not only already made, but were already completed, that, you know, they'd already been paid and everything. You know, so I'm looking at this like, well, that's nutty. You know, you can't, you know, well, first of all, why are you negotiating for contracts in the past? They're already, so anyway, they, you know, so finally I figured out that, and this guy was very, you know, very aggressive and whatever. And I talking to the guy, he's like, yeah, well, they should be changed. Cause you know, I got them to come down. Blah, blah, blah. I said, well, okay, if you did that, if there's a $5,000 credit, then it should be made in the year that you renegotiated it, because that's in the past. You know, and well, that's what they told me. That's not right. So anyway, one of the things is that the accounting and IT people caved into this guy and allowed him to go through and change the values for inventory that had already been purchased, you know, whatever. So anyway, that was a mess. And the kicker to that is that the guy left before he actually quit before I think he, whatever, but he quit before the audit was over. The purchasing guy. So we had these weird. I never even thought things that you never even think you're going to run into. I mean, who would have thought that someone's going to try to negotiate a contract that's already been done? But all right. Reperformance is when you actually do the item yourself. There was a problem at one of the audits that I had that they had a problem with returned merchandise. It wasn't being put back in the books. And talking to people, and people really didn't. Some people thought they knew it, but there was a conflicting and all this stuff. So finally, I just said, "Like I'm gonna give me some returns, and I'll go through it." And you know, and so I went through with this other guy. It was in this warehouse, and I'm on this thing that, you know, goes up and down, and I was terrified of the thing. But anyway, you know, I went through it and kind of got a feel for what, you know, where the problems were. And basically the problems were that they were not, that the reshelving of the inventory was done after it was reshelved, and well, it really should have been done before. But it, you know, that wasn't that big of a deal, but it actually made a kind of big deal for tracking the inventory. You know, it's one of those things that if it's done once, it's not that big a deal, but if it's done repeatedly. Analytical procedures. I think I have a big thing on that here, don't I? Maybe I don't. So basically ratios for the most part. But a more specific one is the analytical procedures. Are the puzzle relationships. Oops. Between data. Oops. It could be financial data, it could be other data. I think I got a more, I have a more, I got examples of those. But analytical procedures are plausible relationships that you have between data. For example, if sales go up, what would be a plausible relationship between sales going up and selling expense? So if sales go up, would selling expense go up? Would you assume, would it be plausible for selling expense to go up or to go down? Are you guys sleeping? You guys are sleeping, aren't you? A plausible relationship would, I'll wake you guys up. A plausible relationship is you expect it to go up, right? How do you make more sales? Well, advertise more, or you pay more commissions to people who make sales, whatever. So a plausible relationship between sales and selling expense would be that it would increase. If it doesn't, so you see sales go up and selling expense goes down, well, then it may be a problem. And you look into it. It doesn't necessarily mean fraud, but it will point you in the right direction. Okay. Scanning data. This will be the last thing we do tonight. So scan data for unusual items. A lot of times things that you're looking for, well, one thing you always look for is big round numbers. Usually transactions don't happen in nice round dollars. So if something is $25,000 even, it's unusual. So one of the things you do is you look for those things that are nice big round numbers, and then a lot of times fraud happens in big round numbers. I know it sounds silly and it sounds almost childish that you would try to do it that way, but a lot of times that's exactly what you find is that when people commit fraud, they do it in nice big round numbers. So something will be changed by $25,000 even. A normal transaction would be $25,622.32. But that's not what they do a lot of times. They'll just tack on 25,000 onto the sales or something like that. So scanning data a lot of times will highlight those things that are, that there might be a problem. Repeating numbers, if there's some number that repeats, that might be that they're double billing, telling the same thing twice or something like that. You also look for those sort of things. But scanning the data is one of those things that it's kind of an art, but it's also one of those things that finds a lot of problems. This analytical procedures here, I should mention this up here. This is where they find something like 90 to 95% of all So 90, depending on what you look at, I've seen that way from 90 to 97% of all frauds detected by analytical procedures. So while this might not seem like that big of a deal, it indicates a lot of the possible fraud. A lot of it, if you find, you'll find through the relationship between sales and inventory numbers and that sort of thing. That if sales go up and inventories don't change, cash doesn't change, that sort of thing, that you'll actually find them. So anyway, analytical procedures have a bunch of it.